Hedge funds have seen a meteoric rise in the global economy, and in this video we'll look at what they are, the history of them, one of the all-time greats in the hedge fund world and how he made his money, what shorting and longing mean in finance, the success and challenges of hedge funds, which are the largest hedge funds now, and who are the wealthiest hedge fund managers around today. So please do like this video and subscribe to the channel so I can continue to offer more content for you in future. Just a reminder that nothing contained here is financial advice. And let's jump straight in and take a look at hedge funds in more detail. The idea of a hedge fund was created all the way back in 1949 by Alfred Winslow Jones, who you can see here, with him creating the first hedge fund product in 1952. And hedge funds are pooled investment funds where private investors' money is managed by hedge fund managers. And they use a wide range of strategies and can invest in a range of products rather than be restricted. So they can often be seen as being more risky, using alternative investments, such as using leverage, short selling, derivatives or non-traditional assets, etc., in order to beat or earn above average market returns. And if we break down the words hedge and fund, we can simplify the description as essentially being a fund that hedges market risk to continue growing over the long term, put simply. And they are usually only available to high net worth and institutional investors. And given that hedge funds are lightly regulated and contain highly mobile capital, hedge funds certainly represent free capital movements. And the godfather of these hedge funds was George Soros. Born into a Jewish family in Hungary and then educated in London, Soros then moved to the US in 1956. In his book, The Alchemy of Finance, published in 1987, that you can see pictured here, he begins with a bold critique of the fundamental assumptions of economics. Soros believes that financial markets can't be perfectly efficient because prices are reflections of the ignorance and biases, often irrational, of millions of investors. He is also a large proponent of the theory of reflexivity, which is quite complex, but is basically where market participants operate with a bias, and their bias can influence the course of events. And as you can see here, this is a feedback loop between expectations of investors and future economic events. So investors' biases affect market outcomes, which then in turn change investors' biases. And it goes round and round because, again, this affects market outcomes. So he looked a lot at the difference between perception and reality. Or in the case of a financial bubble, he says that every bubble consists of a trend and a misconception. And if we now look at some of Soros's investment decisions, he knew how to make money from long positions. And if you're not quite sure what this is, it's basically buying assets with the expectation of future price rises, as you'll then be able to sell them for a profit, obviously. But for Soros, in 1969, he was long real estate. Then in 1971, he was long Japan. In 1972, this was bank stocks and oil. In 1973, this was for US defense stocks because of the Israeli complaints about US supplied hardware in the Yom Kippur War. And he was right about all of these things, which made him a lot of money and is very impressive. He also set up in this time his Soros Fund Management in 1970, and then Quantum Group of Funds in 1973 with Jim Rogers. So having looked at what a long position is, let's now look at what shorting is, because a short position is basically the opposite. So rather than buying an asset with the expectation that it will go up in value in future and you can make a profit by then selling, with a short position, you actually bet that the price will decrease in value So an example of this would be borrowing whatever you thought would go down in value in future and then paying it back at the lower cost when it does drop in value, and therefore making a profit that way. But coming back to hedge funds and George Soros, originally created to hedge against market risk with short positions, which, as we've just seen, actually make money if a security goes down in price, a hedge fund provided the perfect way for Soros to exploit his thoughts on reflexive markets, which we've just looked at. And Soros's biggest wins actually came from being right about losers, not winners. And let's take a look at some examples of these. In 1985, telegraph company Western Union, when fax technology threatened to destroy its business. September 1985, the US dollar plunged after the Plaza Accord agreement among the G5 nations of France, Germany, the US, UK and Japan. In that year, Soros saw his fund grow by 122%. But his greatest short was one of the most monumentous bets in British financial history. So let's take a look at that now. Because in 1992, there was $1 trillion being traded on foreign exchange markets every day, versus the Bank of England holding £906 million in capital and reserves. Soros thought that the rising costs of German reunification of West and East Germany would increase interest rates and therefore the Deutschmark. Soros then predicted that the British Conservative government's policy of shadowing the German currency when it joined the European Exchange Rate Mechanism, or ERM, in 1990 would make its position untenable or weak. He then thought that as interest rates rose, the British economy would struggle, and sooner or later the government would have to withdraw from the ERM and devalue the pound. And what Soros did was bet $10 billion on shorting the pound, which was more than the entire capital of his fund. So he effectively borrowed sterling in the UK and invested this in the German Deutschmark. So to put it simply, he borrowed British pounds, anticipating that he'd have to pay this back at a later stage at a much lower price because the pound would drop in value. And he invested it in the German currency, expecting that to rise. So what was the outcome? Well, again, Soros was correct, as you can see here from this graph, and his fund made more than $1 billion as sterling slumped, allowing him to repay the sterling he'd borrowed at a much lower exchange rate and pocket the difference. To put it into perspective, this trade accounted for just 40% of that year's profits. The success of Soros's quantum fund that he set up in 1973 was incredible. And if someone had invested $100,000 into his fund when he set it up and reinvested all of their dividends, they would have been worth $130 million by 1994, which is an annual growth rate of 35%. And you can see his net wealth in 2024, according to Forbes here. So he's not doing too badly at position number 43 with a net worth of $6.7 billion. He's also put over $32 billion of his own money into setting up a foundation that has apparently already handed out over $19 billion. So these new hedge funds, like the one we've just seen of Soros, were seen as being more calculating because they had no loyalty to any particular country when it came to investing. And they would easily just short the dollar, the pound or whatever to maximize their returns. Also, the sheer amount of money that these people had at their disposal was another difference between what had happened in the past, with arguably the markets now being mightier than any government or central bank. And these hedge funds would apply maximum leverage to their bets if they were confident about it to again maximize their returns. So what are the world's biggest hedge funds? Well, the majority of the largest hedge funds are based in the US, For example, some of the biggest names you can see here, such as Bridgewater, Renaissance, AQR, Citadel, etc. And we'll revisit some of these companies soon when we look at who the wealthiest hedge fund managers and CEOs are. But outside of the US, Man Group is the largest London-based hedge fund currently that has experienced large growth, as you can see here, over the past decade in terms of assets under management. However, running or setting up a hedge fund isn't easy. Of the 1,308 hedge funds that were formed between 1989 and 1996, 36.7% of them ceased to exist by the end of that time frame. The average lifespan of a hedge fund was just 40 months. And yet, the number of hedge funds has exploded in number. In 1990, there were just over 600 hedge funds, managing around $39 billion in assets. Then by 2000, there were 3,873 funds with $490 billion in assets. In 2008, there were 7,601 funds with $1.9 trillion in assets. And then finally, in 2024, there are apparently 30,077 hedge funds globally, managing just over $5 trillion in assets. As we've seen, the US dominates the market with 65% of them, with the UK the next country with 9%. And it is true that there are more hedge funds than Burger Kings in the world. And this is given the relatively high failure rate of new hedge funds and their lower rate of returns, averaging 18% returns in the 1990s to 7.5% in the 2000s, and then 8.2% in 2023 after a difficult 2022. Even the top 50 hedge funds trailed the S&P 500 in the 5 years before 2021, with hedge funds generally performing worse than the S&P 500 every single year since 2011, which is quite a striking statistic. And as of May 2024, hedge funds have seen 22 consecutive months of net outflows, totaling $25.6 billion in the first quarter of 2024. But despite this, hedge funds have performed quite well in Q1, with returns of 4.6% on average during this time. So why are hedge funds so popular? Well, a reason could probably be all those people looking at the vast wealth of the richest hedge fund managers. And as of 2023, the top 3 wealthiest hedge fund managers and CEOs were Ken Griffin of Citadel, who's worth $35 billion, Jim Simons of Renaissance Technologies, who's worth $28.1 billion, and Ray Dalio of Bridgewater Associates, who's worth $19.1 billion. Indeed, the 20 richest hedge fund billionaires are worth about $245 billion, which is up $4 billion from a year previously. And there are other names in the list when you look at those who were paid the most in 2023, rather than overall wealth, with Israel or Izzy, Englander, topping the list, and David Tepper and Steve Cohen being mentioned also. So it's quite clear to see that the biggest hedge funds attract the most money, which could explain the difficulty for others, with 70% of all money held in hedge funds with more than $5 billion in assets under management, or AUM. And they generally perform better too, as you can see here, when you compare them against smaller hedge funds in terms again of assets under management. So that ends this video looking at hedge funds. And as always, I'd love to know what you think in the comments below about them. And if you are interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.